A striking feature of many modern central banks is their independence. They are deliberately kept at arm's length from day-to-day politics. This arrangement is important and sometimes debated, and understanding the reasoning behind it illuminates how central banks are meant to work. Central bank independence means that, although the central bank is a public institution set up by law, it makes its monetary policy decisions, such as setting interest rates, without direct control by politicians. Governments typically set the central bank's goals or mandate, but the bank decides how to pursue them on its own judgment, insulated from short-term political pressure. Why arrange things this way? The core argument is credibility and stability. Politicians may face temptations to favor short-term boosts, for example, keeping interest rates low or creating money to stimulate the economy before an election, even when this risks higher inflation later. History suggests that when monetary policy is subject to such pressures, inflation can become a serious problem. Independence is meant to shield decisions from these temptations, so the central bank can focus on long-term stability, especially controlling inflation, even when that requires unpopular choices. The idea is that a credible, independent central bank, committed to stable prices, earns public trust, which itself helps keep inflation expectations and inflation in check. For example, an independent central bank raises interest rates to curb inflation even though it's politically unpopular, a decision it can make precisely because it is insulated from short-term political pressure. Central bank mandates, tools, and targets vary from one country to another, and they change with economic conditions. Even economists disagree about how policy and money creation really work, so check which institution sets the rules where you live. The main lesson is simple. Many central banks are independent, making monetary decisions free from short-term political control, on the view that shielding decisions like interest rates for politics leads to more stable, credible management of inflation.